Good afternoon, everybody. The August 8th, 2016 School Land Board meeting will now come to order. First item on the agenda is approval of the minutes from our last meeting on July 19, 2016. Assuming no questions, comments from the board, I can entertain a motion to approve said minutes.
So moved.
Motion is made, seconded, and carried unanimously to approve the minutes. Next item on the agenda is the approval of the consent agenda as posted. Item number 2A -11 has been pulled from the docket prior to the meeting. After having a chance to review, and assuming no questions or comments on the consent agenda, I can entertain a motion to approve said consent agenda.
So moved.
Motion is made, seconded, and carried unanimously to approve the consent agenda. Next item on the agenda is number 3 as stated.
Thank you, Mr. Chairman. Members, for the record, Rusty Martin, Chief Investment Officer. We have 2 agenda items left today, 3 and 4. Number 3 will be an action item, and number 4 will not be an action item. This agenda item affords the School Land Board the opportunity to consider the release of funds from the Real Estate Special Fund account, which we call the RESFA for short, for investment in the Permanent School Fund by the State Board of Education during fiscal years 2018 and 2019. Section 51.413 of the Natural Resources Code authorizes the School Land Board by resolution to release funds from the RESFA to either the Available School Fund or to the SBOE for investment in the Permanent School Fund. Also, Title 31 of the Texas Administrative Code, Section 151.6, requires that the Chief Investment Officer of the General Land Office perform an analysis regarding the potential release of money from the RESFA by July 31st of each even-numbered year, and then to provide the results of that analysis to the School Land Board and make recommendations concerning the potential release of money from the RESFA. Accordingly, I have performed the analysis required by and described in Title 31 TAC Section 151.6, and the results of the analysis are contained in the memo before you. It shows that the amount available for release in fiscal year 2018 would be $235 million, and that the amount available for release in fiscal year 2019 would be $255 million, for a total of $490 million. Therefore, I recommend that a total of $490 million be released from the RESFA to the State Board of Education during fiscal years 2018 and 2019. As provided in the resolution that was attached, the School Land Board will release $235 million from the RESFA during fiscal year 2018 in 4 equal installments of $58.75 million each, and $255 million during fiscal year 2019 in 4 equal installments of $63.75 million each. Such amounts will be deposited in the State Treasury to the credit of the State Board of Education for investment in the Permanent School Fund, and I'm happy to answer any questions.
Just to refresh my memory, what did we do in 2017 and 2016?
175 and 200. So the amounts are growing pretty substantially each period.
And this came out to what percentage of the total investable assets of the portfolio?
Sure. The way that the calculation is done is it takes 6% of the 16-quarter trailing average of the market value of the assets. So this is 6%, and then we for the first year, and then we use a methodology to forecast what the year following will look like, assuming that 6% would be used to.
And just to be clear, that's not a required amount. That was it's a pretty strong amount, higher than what would be required by law.
That is right. We actually have no requirement to release any money. The State Board of Education has a requirement through the Constitution to release 0 to 6% of their trailing 16-quarter average market value, but we have no such requirement.
So it can be safe to say that we're outperforming our friends at the State Board of Education. So I'm trying to lead you.
With regard to the percentage of the trailing 16-quarter market average that we release, that's a fair statement. They typically are in the 3 to 4% range. Maybe they
As long as we
could
have
be
that on the record.
encouraged to raise that.
Move to approve.
Motion is made, seconded, and carried unanimously to approve item number 3. Next item on the agenda is number 4.
Thank you, Mr. Chairman, members. Again, this is a non-action item. I'm pleased to present you with a quarterly investment report for the Texglo Permanent School Fund Real Assets Investment Portfolio for the period January 1st through March 31st of this year. The calculations and the data that are presented in the report were prepared by State Street Bank and its Private Edge Group, which are the custodial accounting and performance measurement agents for the portfolio. Just to give you a brief market summary, GDP in the first quarter increased at an annual rate of 1.1%, down slightly from 1.4% in the fourth quarter of 2015. Current consensus indicates an expected average annual GDP growth of only about 2% for the whole year 2016. Also, during the period, unemployment remained unchanged from the fourth quarter at 5%. Fed policy was unchanged during the quarter. They left their Fed funds rate target at 0.25 to 0.50%. They also continue to maintain their current policy of reinvested principal payments from their holdings in agency mortgage-backed securities and rolling over maturing Treasury securities at auction. And I expect that will remain in place until a normalization of Fed funds rate is well underway. Also, the Fed expects that economic conditions will evolve in a manner that warrants only gradual increases in the Fed funds rate. I think that's being proven out. Certainly, we're in August of this year, and the last increase that they made was in December. There may be one more this year. That's a topic of discussion in a lot of quarters. Some people say in September, some say in December. Personally, I think if they do anything else this year, it'll be in December. The actual path of the Fed funds is going to depend on the economic outlook, and they're going to monitor economic data to make that determination. In the commercial real estate market, NPI returned 2.21% for the quarter. Its trailing one-year return was an amazing 11.84%. The real estate market has really been performing very well for quite a period now. All of the quarterly individual sector returns were positive for the 24th time since the second quarter of 2008. Retail and industrial were the best performing sectors, and hotel brought up the rear. During the quarter, hotel was at 1.16%, retail 2.96%, apartment 1.87%, industrial 2.96%, and office 1.72%. Another strong quarter from real estate. In the energy markets, WTI oil prices, again, were highly volatile, and they fluctuated between $30 and $40 a barrel for most of the period, but ended down approximately 0.5% for the quarter at $36.94. By comparison, today we were earlier in the day above $43 a barrel. Even though the world oil surplus is likely to continue through the end of this year, most analysts still expect a significant price recovery by early next year. And that's mainly due to the fact that current pricing just does not generate acceptable drilling economics in most of the non-OPEC producing areas. So that should result in a significantly reduced global supply over the next several months. Natural gas prices fluctuated between $1.90 and $2.30 per million BTU for most of the quarter, and they finished down 6% for the period with an average price of $1.99. That was the fifth straight quarter below the $3 level. The decrease was primarily caused by unseasonably warm weather, which led to an inventory buildup, even though production growth finally slowed during the period. Oversupply is going to be a continuing problem for the near future due to warmer than normal weather and the fact that LNG exports probably won't come online until sometime in 2017. If you turn to page 2 of the report, you'll see the performance summary there. I'll go through those numbers briefly for you. Total net asset value at the end of March was $4.915 billion. 2.246 of that is in the external portfolio. That's 46%. The internal portfolio is $251 million, which is about 5%. The performance numbers for the quarter, starting with external, It was 1.59% for the quarter versus the benchmark of 1.86%, so 25 basis points under the benchmark. And that was entirely related, of course, to continued negative performance of the energy sector of the portfolio. Real estate was up 2.66 for the quarter, and infrastructure was up 1.68. The energy sector dragged down the portfolio. It was down 0.84%, of course, due to continuing oil and gas commodity price weakness. On the 1-year, 3-year, and 5-year returns, 1-year return 10.11%, it's 103 basis points over the benchmark of 9.08. 3-year return 12.82 versus 9.65, so 317 basis points over the benchmark. And the 5-year continues to be very strong, 15.61% versus 10.26 on the benchmark. So exceeding the benchmark on the 5-year return by 535 basis points. At the end of the period, about 40% of our total capital commitments remained unfunded, 27% of real estate, 51% of infrastructure, and 49% of energy. The internal portfolio for the period finished at 1.16%, or 70 basis points below the benchmark. The 1-year return is 13.22 versus 9.08, and the internal portfolio has now experienced 21 consecutive quarters of positive returns. On a combined basis, the portfolio for the quarter was a 1.54 versus the 1.86 on the benchmark. The 1-year return is 10.46 versus 9.08, 138 basis points over. And the 5-year return is 14.41 versus 10.26, or 415 basis points over the benchmark. As far as diversification is concerned, from a property basis, on an invested basis, the combined portfolio is still generally overallocated to real estate. It's at 51% versus a target of 33%. However, that is changing and will continue to change over time as more of the commitments to infrastructure and energy are funded. And in fact, at the end of the period, on an allocated, invested plus unfunded commitment basis, real estate is down to 41%, so getting much closer to the target. On the geographic side, we're very close to the target allocation for each of the regions currently. The allocation to the U.S., excluding Texas, is about 80% compared to a target of 75%. Allocation to Texas is 11% compared to a target of 15%, and the international allocation is now around 9% compared to a target of 10%. That's the end of the report. This is a non-action item, but I'm happy to answer any questions you might have.
Good. Thank you, Rusty. Thank you, Rusty.
Thank you.
That being a non-voting item and there being no further business before the school land board, we will hereby adjourn this meeting. Thank you, everybody very much.
Thank you. Most record meeting.